Hi students, myself DVS Subramanyam. Welcome to Shrestha for CA and CMA, which is exclusively providing CA CMA courses at digital platform. In this lecture, I cover topic called Prospectus. So before beginning a lecture, if you observe, no entire Companies Act is divided into 470 sections, and all these 470 sections are segregated in 29 chapters. At CA interlevel, we had 10 chapters. Balance 19 chapters you will read at CA final level. Now coming to these 10 chapters, we already completed chapter 1 and chapter 2. In chapter 1, everyone knows about what is a company, types of companies. So about basics, simply what is a company and what are the types of companies involved. Now after getting knowledge about a company, we'll proceed with incorporation of company. Sir, is incorporation mandatory for company? Yes, because when you go through the definition of company, company means company incorporated under Companies Act 2013 or any previous company law. So definition itself is telling company comes into existence through incorporation. Okay, sir, how to incorporate a company? All these topics you learnt under chapter number 2, that is incorporation of companies. Next, sir, company, we incorporated company. Now company want to start business. For commencing any business, definitely funds are required. Definitely funds are required for starting a business. Now the point is how to collect money. Yes, you can offer shares to the existing members. So you can offer shares to the subscribers. Subscriber will subscribe the shares, and definitely company will get funds. But if company want more funds, how? So this topic will be dealt under chapter number 3, that is prospectus. So before proceeding into the chapter, let us watch a small AV. So this is basically a car manufacturing company, ma. So you can observe a lot of plant and machineries are required for manufacturing a car, and raw material, definitely labor. Without labor you can't complete manufacturing process. So designers, you can observe how manufacturing is going on, installation process, everything. So again, these labors are classified into two types: skilled labor, unskilled labor, a semi-skilled labor. So three types: skilled, semi-skilled, unskilled. So everything is, every manufacturing process, a lot of machines were involved. So definitely, for installation of all these plant and machineries, recruitment of skilled labor and raw material, I need more and more funds. Estimation, rough estimation, some 10,000 crores. No, 8,000 crores for installation of plant and machinery. No, purchase and installation of plant and machinery. Raw material, some 1,500 crores. And working capital, simply, working capital, some 2,000 crores, including labor. So I need 10,000 crores for setting up a factory which can manufacture cars. So I want 10,000 crores. Definitely these kind of projects, they had long gestation period. So gestation period means the moment you invest money and the time generate revenue, the time gap between investment and generation of revenue, we call it as gestation period. So these kind of projects definitely have long gestation periods. So for getting 10,000 crores, if I go for alternatives, the first alternative I had is bank loans. Definitely I can get bank loan. But the point, from day one onwards, I need to pay interest. From day one onwards, I need to pay interest. Right. So I need loan, definitely. Banker will expect interest from day one onwards. But it will take some 2 to 3 years. Now after 2 to 3 years, when my first car get out of it, after selling the cars only, I can generate revenue. Now how can I pay lump sum amount to the banks from day one onwards, in terms of installments or, in interest payments or principal repayments? So definitely not possible. Now the other opportunity or other alternative I'm having is go for issue of securities to public at a large. Now when you ask for a bank loan, banker will ask you a number of questions. Why you want funds? How can you repay them? So what is your project? Commencement of the date, date of commencement of the project, date of completion of the project, how many cars you produce every month, how many cars you can sell, how much revenue you can generate every month. So how can you pay interest? How can you pay principal? N number of questions banker will ask me. Similarly, when I go to public at a large, definitely they will ask me questions. Sir, how much funds you want? What is the purpose of raising these funds? And how are you going to start the project? So schedule, simply date of commencement of project, date of completion of the project, and date of generation of revenue. So how you are going to sell them, how you are going to generate profits, and how you are going to pay dividends, or simply other expenditures. So these are the n number of questions generally an investor will put up. All these questions, all the answers to these questions, I simply reply through a document called prospectus. Now what is a prospectus, sir? It's a simple document, ma. It's a simple document which contains prospects of the company. It provides two kinds of information: financial information, non-financial information. So financial information means past track record. So last 3-4 years, my company financial position, my company financial performance. So non-financial information, my company key managerial personnel. Simply, we call them as KMP. Promoters, directors, their track records, company achievements, all this comes under non-financial information. And prospectus will provide three tenses of information. It provides past information, present information, future information. Sir, past, simply track record. Present, why I need funds. Future, projected cash inflows, projected revenue, projected financial performance, projected financial position of the company. So all these information I'll put in a document called prospectus. So simply I call prospectus means a document which explains prospects of the company. So this is general information. I'm not going into the lecture. I'm not going into the lesson. So this is basic information one should know about prospectus. Everything today, suppose a student want to take CA admission. Yes, we had ICI prospectus. So levels, CA foundation, CA inter, CA final, number of papers, examination criteria, qualification criteria, how can you become member of the institute, So everything you'll find in the document. So simply company prospectus, it explains about the company. So one of the advantages of floating a company is raising capital. Floating a company is raising of capital. Capital should be raised from public at a large or from a defined group or inner circle. The former is called public offer and the later we call it as private placement. So there is a difference between both public offer and private placement. When I'm going to public at a large, it's a general offer. Any person from public can subscribe, can make an application for my securities. General offer prospectus. Or I'll go with specified persons, identified persons, up to some 200. No, we will discuss it under section 42, don't worry. So with a limited number of persons, I'll go to limited number of members, limited number of persons. So I will ask them to apply for my securities or to subscribe my securities. It is nothing but private placement. So private placement comes under special offer. Public offer comes under general offer. Any person from public can apply for securities. Next one. Capital acquisition is inflow of funds for the issuer and needs advertisement which should be in accordance with the relevant legal provisions so that investor is not defrauded or be fooled. Of course, the main purpose of Companies Act, the main purpose of SEBI Act is to protect investors from the company small practices. You know, some people will incorporate companies to defraud the public or to fool the public. So remember one point, my dear students, the main purpose of administrative laws like Companies Act, LLP Act, SEBI is simply to administer the body corporates so that public gets protected. This is the main pillar. This is the main pillar. The main objective of the lawmaker in framing Companies Act is to protect the public. On successful closure of application process, securities are allotted to the investors, which could be then listed on an appropriate segment of a recognized stock exchange. So if you observe the process, first company will issue prospectus to public. Now public, after looking into the prospectus, if they are interested in the company securities, they will file application. We call it as application, and company, based on the application, it will make allotment. So through allotment, equity shares comes into the picture or securities comes into the picture. So difference between securities and shares I will discuss within a few moments. So concentrate on the introduction part. So allotted to the investors, which could be then listed on a relevant appropriate segment of recognized stock exchanges. Next one. The provisions relating to the raising of capital, such as issue of prospectus, allotment of shares, etc., and other matters incidental thereto, are contained in chapter number 3 of Companies Act 2013, which is divided into two parts. I told you previously. So entire Companies Act, we had 470 sections, and all these 470 sections are segregated into 29 chapters based on the subject. Based on some criteria, these are classified into 29 chapters. So all provisions related to incorporation, you will find under chapter number 2, incorporation of the company and incidental matters there too. All the provisions relating to the offer of securities, public offer of securities, private placement, you will find under chapter number 3. Provisions relating to share capital and debentures you will find under chapter number 4. Deposits, chapter number 5. Charges, chapter number 6. And management and administration related provisions, chapter number 7. Dividends related provisions, chapter number 8. Accounts, you will find under chapter number 9. And audit and auditors, you will find under chapter number 10. Everything is interlinked. At the end of this session, you will come to know how these provisions were framed. So my concept is very simple. Now what is there in material? Don't focus on what is there in material. Why it is there in the material? Why the provision was framed like that? If you understand the logic, definitely you can remember this section. You can remember the provision in that section. So try to concentrate on concept listening. If you get concept clarity, definitely you can write any kind of question. Next one, part 1. Public offer of the chapter comprises section 23 to 41, and then part 2, section 42. So now coming to the chapter prospectus and allotment of securities. I repeat, this is not prospectus and allotment of shares. This is prospectus and allotment of securities. So here The entire chapter is divided into some 4 parts: issue of prospectus and related matters, allotment of securities, penalties, private placement. So general provisions, issue of prospectus. After issue of prospectus, we will receive applications. Based on the applications, we will make allotment of securities. And when you override provisions of the Companies Act, you are subject to punishment. That means penalties. And last part, private placement. Okay, my dear students. So question number one. Question number one. Write about issue of securities by public and private companies. Write about issue of securities by public and private companies. So here we had two companies, ma. Here we had two companies. So companies classified into two types: public, private. Public company, private company. Public company can offer securities to its existing members either under rights issue, rights or bonus or to identified persons under private placement. And the last one is public through document called prospectus. And if you observe private company, private company had only two modes. One is existing members and the next one is identified persons. Sir, why not public, sir? Do you remember section 2 clause 68 of Companies Act 2013? What is a private company? Private company, its article should contain 3 points: restricts, limits, prohibits. Restricts transfer of shares. Now, to protect confidentiality, there are restrictions on transfer of shares. Next one, limits the number of members to 200. Now coming to the third point, prohibits. A private company is prohibited from inviting public, inviting offers from public for purchase or subscription of securities. So that means a private company is prohibited from issuing prospectus. Prospectus is nothing but invitation to offer. I told you just now. See, prospectus, company will issue prospectus to public. It is an invitation to offer. And public will file offers in the name of applications. If company is okay with that application, company will make allotment. That is nothing but allotment is nothing but acceptance. So private company is prohibited from inviting offers from public for purchase or subscription of securities. Understood. That's why private company only 2 modes, public company 3 modes. So by public company, a public company may issue securities to public through prospectus by complying with relevant provisions, and through private placement by complying with the relevant provisions, or through a rights issue or bonus issue in accordance with provisions of the Act and SEBI regulations in case of listed companies. Next one, by private company. A private company may issue securities by way of rights or bonus to its existing members, complying provisions of this Act, and through private placement by complying with relevant provisions. So here you find word relevant provisions. Why? Private placement is governed by section 42. And rights issue section 62, bonus issue 63. So instead of writing section names, simply write accordance with relevant provisions of the Act. According to the relevant provisions of the Act. So each and everything, for rights issue there are conditions, for bonus issue there are conditions, for private placement there are conditions. We'll discuss in the upcoming classes, so don't get worried. Now coming to the definition of public offer. Sir, what is a public offer, sir? So here there is no definition to the public offer, but public offer covers certain offers. We are not defining public offers. Here we are giving a definition. Definition is like this. Public offer includes, so first of all it is inclusive definition. It covers IPO, initial public offer, FPO, further public offer. So what is the difference between IPO and FPO, sir? After incorporation, for the first time company is coming for public offer. After incorporation, for the first time company is coming for public offer, we call it as IPO, initial public offer. For the first time it is coming to the public. It is first time it is offering securities to the public. And any public offer subsequent to initial public offer is a further public offer, or there is one more term, follow on public offer. But according to our material, further public offer. So remember, And the definition of public offer, public offer, whenever you are making public offer, you need to issue prospectus. Whenever company is making public offer. By the way, which company can make public offer? Option A, public company. Option B, private company. Tell me, which company can make public offer? Obviously, public company. Private company is prohibited. Section 2, clause 68. Don't forget. So now, every public offer requires prospectus. First of all, what is a public offer, sir? Public offer includes IPO, FPO. That means company is required to issue prospectus not only at the time of IPO, but also at the time of FPO. So 2 times. Suppose our company is making 10th public offer, sir. For 10th public offer also prospectus required. Yes, because this 10th public offer comes under further public offer, and further public offer is already covered under the definition of public offer. So prospectus is required not only at the time of IPO but also at the time of FPO of securities to the public by a company or an OFS to the public by an existing shareholder through issue of a prospectus. So by this you can call it as like this, definition of public offer: IPO plus FPO plus offer for sale of securities. See, in this public offer, the offers are of 2 types. Of course, I told you IPO, FPO. In initial public offer, in further public offer, offers are of 2 types. One is offer for sale and the second one is fresh offer, fresh issue. Offer for sale, fresh issue. So what is this offer for sale? Venture capitalists or promoters or existing members, they want to sell their shares. So through company, with the help of company, they will offer shares to the public. That means indirectly. So company is offering directly shares to the public, but indirectly who is offering those shares are existing members. So they want funds, they want to invest those funds in some other business. So for that they want to sell the shares. So now they will come to the company through offer for sale. It provides an exit route to the existing members. Are you getting it, everyone? Okay, fine. So every public offer covers 2 issues. One is a fresh issue, the second one is offer for sale. In detail, I'll discuss offer for sale under section 28. Don't get tensed. This is just introduction class. In detail, I will cover each and every point under section 28. In fresh issue, whatever money company is collecting, it will retain that money. Whereas under OFS, company will take shares from the existing members and company will offer existing shares to the public. So company will collect money from public and this money company will give it back to existing members. So OFS is different, fresh issue is different. Because of OFS, there is no change in balance sheet of the company. There is no cash inflow, there is no cash outflow, because whatever money company is getting from public, it will divert that money to the existing members. That we call it as offer for sale. And next one, fresh issue. See, here I'm using the word sale. Sale is different, subscription is different. Through subscription, company share capital will be increased, but through sale there is no increase. Example, if you observe stock market, I want 10 shares of Reliance Industry Limited. I'll open Demat account. I will order for 10 Reliance Industry Limited shares. So someone who is ready to sell at the price fixed by me, they will sell the shares to me. So this is nothing but sale. Because of these transactions, buying shares from the existing member, do you think company financial statement gets affected? See, today Reliance Industry Limited face value share is 10 rupees. If you observe balance sheet under equity share capital, only 10 rupees will be shown, because paid up share capital, balance sheet will contain paid up share capital, not issue price. The difference between issue price and paid up share capital, or sorry, face value and issue price, the difference, it will be credited to securities premium. Some 2 years back, it offered shares at 2,700 rupees. Imagine 2,700 rupees. Face value 10. So remaining 2690 rupees shall be credited to securities premium. Only 10 rupees shall be credited to share capital. Are you all getting my point, students? So through subscription, company share capital will increase. But through sale, there is no impact on balance sheet, no impact on financial statements. Whatever money company collect from public, company will give it back to existing members. That is what offer for sale. But coming to fresh issue, company will retain the money. Company will use that money for expansion purposes or for repayment of the debt. So I'm giving you overview the difference between OFS and fresh issue. But both these elements, OFS and fresh issue, are covered under public offer. So let us consolidate. When prospectus is required, when company is making public offer. So public offer means what? What is the definition of public offer? You know, public offer not only covers initial public offer but also covers further public offer. And coming to each and every public offer, it not only covers fresh issue but also offer for sale. Under offer for sale, company will take shares from existing shareholder and they will offer those shares to the public. So for that also prospectus is required. So simply, when prospectus is required, when company is making initial public offer, required. When company is making further public offer, required. When company is offering securities under IPO or FPO which are belonging to the members, then also prospectus is required. Everyone. So first see the definition of the prospectus. So what is prospectus, sir? What is prospectus? If you go through the definition of prospectus is classified into two parts. One is prospectus means, and next one, prospectus includes. So means exhaustive definition, everything is covered. Includes, inclusive definition. Only if these items are covered, in future there is a probability that new item may be covered. So means exhaustive, complete definition. Includes, it is nothing but, you know, inclusive definition, incomplete. For the time being, these points are treated as prospectus. In future, some more points may be added. Okay, fine. So let us decode the definition. Prospectus means, what is a prospectus? Prospectus means any document described or issued as a prospectus. Very simple definition. See, what is a prospectus? Prospectus means any document described or issued as a prospectus. That means if any document contains the name, it is a prospectus, then it is a prospectus. If you take any document, for the time being, take any document, on that document if you find name called prospectus, then the document is treated as prospectus. So what is the need of defining prospectus? Why we need to read prospectus definition? Very simple. This chapter is applicable to prospectus. This chapter number 3 of Companies Act 2013 is applicable to prospectus. So what is a prospectus? So fundamental responsibility to define a prospectus. So prospectus means any document described or issued as a prospectus. Simply, you know, named prospectus. If any document contains the name prospectus, it is a prospectus. Later we will study what should be the contents of the prospectus. We will read under section 26. Don't worry. First of all, what is a prospectus? Which contains the name, you know, which is described or issued as a prospectus, we call it as prospectus. And prospectus includes a red herring prospectus, shelf prospectus. So any notice, circular, advertisement or any other document inviting offers from public for subscription or purchase of any securities of a body corporate. So here we had 3 points. Red herring prospectus. For the time being, red herring prospectus, it is a one type of prospectus with incomplete particulars. Red herring prospectus means incomplete prospectus. Detailed explanation will be provided under section 32. Don't worry. Next, the shelf prospectus. You know, this is like durable prospectus. Under single prospectus, you can offer multiple. You can make multiple public offers. you can make multiple public offers under single prospectus. We call it as shelf prospectus. Detailed explanation will be given under section 31. And coming to the last point, deemed prospectus, it is very important to understand this point. So this point focus on purpose of the document. If you see the first point, name, if it contains name prospectus, it is a prospectus. And if you see the C point, if you see the C point, purpose. Now company is issuing a document. Name might be notice, name might be circular, name might be advertisement, or name might be anything. So company is issuing document. Acha, what is the purpose of issuing that document? Sir, it is inviting offers from the public, sir. Okay, any document inviting offers from public, is it a prospectus? No, don't come to the conclusion. You might observe in the Hindu or Deccan Chronicle, suppose required some 50 engineers for a project, or required 50 chartered accountants. Now that advertisement is inviting offers from chartered accountancy society or engineer society. So it is also an invitation to offer, but that is not a prospectus under chapter number 3, prospectus and allotment of securities. So simply inviting offers from public is not a prospectus. Why it is inviting offers? Sir, it is inviting offers from whom? Public, for subscription or purchase of any securities of a body corporate. I wondered after reading this definition, because inviting offers from public, okay, that offer is with respect to what, sir? Securities, and they cover two words, subscription, purchase. So what is subscription, what is purchase? Just now I told you, when existing members are offering shares, and when you are purchasing those shares, we use the word called sale, purchase. So there is no impact on the financial statements of the company. Simply company, in the hands of company, cash inflow, cash outflow, purchase. So that means OFS is covered. And subscription, through subscription, company share capital will be increased. Cash inflow, if you observe cash flow statements, we had 3 activities: operating, investment, finance. So it comes under finance activity. So company share capital will increase. In liability side, in asset sides, cash balance gets increased. So both aspects are covered, subscription, purchase. Next one, any security. So securities is a broader term. Instead of calling shares, we use word securities. Securities is an inclusive term. Next point, we will discuss securities only, don't worry. Of a body corporate. I got a doubt, why lawmaker used word body corporate? Why not company? Because body corporate, if you read the definition of body corporate, if you had knowledge of body corporate, it includes a company incorporated outside India. Today, because of globalization, liberalization, privatization, LPG schemes, right? So because of these schemes, a company will offer securities not only in domestic market, it can offer securities outside markets also. If you take, for example, if you take Alibaba Group, so China based company, it came to India and it is offering Indian Depository Receipts, IDR. Now they are also treated as securities, and offering person, it's not company, because company means company incorporated under Companies Act 2013 or any previous company law. So taking foreign companies as an example, they're incorporated outside India and having place of business in India, and they're offering sometimes securities. So in that case also, that body corporate should issue a prospectus. Understood, ma? So instead of using word company, they use body corporate. That means, it's a broader sense. Body corporate includes company. Everyone know. If I ask you what is a body corporate, everyone will tell, sir, body corporate includes company. Every company is a body corporate, sir, but every body corporate need not be a company. You know it. So body corporate means an incorporated association. If such incorporation happens under Companies Act, we call it as company. If incorporation happens under LLP, we call it as LLP. Understood? So consolidate that C point, and finally, offering document, it may contain a name like notice, circular, or advertisement, or any other document. So the document If it is inviting offers from public, sir, purpose, subscription or purchase of securities of a body corporate, now we call that document as a prospectus. And chapter number 3, prospectus and allotment of securities provisions shall apply to the document. Once we define prospectus, now we will apply provisions of chapter 3. If any provision is violated, penalty, and we treat that allotment as irregular allotment. Are you all getting it? So with this, definition of prospectus completed. Definition of prospectus completed. So how we discuss, first thing, modes of issue of securities. A private company can offer securities in 2 modes. A public company can offer securities in 3 modes. Coming to the third mode, it is nothing but, company, public company, it will offer securities to public through prospectus using document called prospectus. So what is a public offer? Public offer includes IPO, FPO, they cover OFS. Next, what is a prospectus, sir? Any document described or issued as a prospectus. First one. And red herring prospectus, shelf prospectus, deemed prospectus comes under the definition of prospectus. Now to this prospectus, chapter number 3, prospectus and allotment of securities rules will apply. So next point, very interesting point, let us decode securities definition. Securities. Securities means securities as defined in section 2 clause H of Securities Contract Regulation Act 1956. One more interesting definition we had. Why? Because Companies Act is not defining word security. It is giving reference. It is giving reference to the Securities Contract Regulation Act. So many times I wondered why Companies Act is giving reference to some other acts. Why can't copy it? The main problem is if that prospective act is amended, again we need to amend Companies Act. Just imagine if I copy securities definition, you can find in the material. If I copy this definition from Securities Contract Regulation Act, if I keep this definition in Companies Act 2013, what happens, Every time when they amend word securities in Security Contract Regulation Act 1956, it requires amendment in Companies Act. So it's duplication, double work. So amendment to the act requires approval of Parliament, a legislative department. So legislative department, so it requires permission of Parliament and President of India. So definitely time taking one, right? So that's why in our Companies Act, if you want to define a new things, we will give reference to the respective acts. So security. What is a security? Security means security as defined under Security Contract Regulation Act 1956. But when you go through Securities Contract Regulation Act 1956, you'll find this list. You'll find this list. Understood? Once again, I'm repeating. Our chapter prospectus is applicable not only to the shares, not only to the debentures, but it is applicable to the securities. So securities is a broader word. Shares is a narrow word. Securities inclusive definition. So securities includes shares, a share in the share capital of the company, scrips, one type of share only. So right now we are not using these words. Stock, it is a bundle of share. Bundle of shares, we call it as stock. Now previously we used these words scrips and stock for transferability purpose. Better transferability, stock is advisable. Shares you can transfer based on lot system, 1 lot, 2 lots. But stock you can transfer in integers also. I can get half stock, I can get 25% stock. Detailed discussion about share and stock I'll give you under chapter number 4, share capital and debentures. Don't worry. Next one, bonds, debentures, debenture stock, debt to the company. Debt to the company. So whatever you heard about security, shares, debentures, everything is covered under first point only. I didn't complete the definition of securities, but everything is covered under first point only. So there are more securities we need to discuss. So debenture stock, it is a perpetual stock and it is a bundle of debentures only. Detailed explanation I'll give you under section 71. Don't worry. Or any other marketable securities of like nature in or of any incorporated company or other body corporate. Simply any security which is having marketability. That means simply transferability. So we call it as security. Security. That means related to shares, scripts, stock, bonds, debentures, all items comes under the definition of securities. Next one, derivative. So example of derivative, I'll tell you, options, put options and futures. In options, you can find call option, put option, futures. So we call them as derivatives. So I told you example of derivative. First of all, what is a derivative, sir? You know, it is a unit which derives the value of underlying asset. It derives the value from underlying asset. You can observe crude oil, crude oil or crude oil, next gold, silver, all these items are covered under the commodities. So primarily our markets, coming to the stock markets, we had two types of stock markets. One is securities like shares, share market. The next one is commodity market. Commodity market exclusively deals with this derivative concept. So the value, the unit value derives from the underlying asset. What is that underlying asset? It might be anything. In future, I will take this gold. I will take this silver at a predetermined price. It is a predetermined price. Simply for understanding, I am telling you, it comes under betting actually. So present, suppose, present the share value of Reliance Industries Limited is 2,700. Or take a commodity example only. Take commodity example. Present value of gold is 53,000. 10 grams of gold is 53,000. Now my expectation in future it may go up to 55,000 and I'm reserving the price at 54. So in future I will purchase 10 grams of gold at 54,000 rupees only. Like that I'm entering into a contract, simply derivative contract, underlying asset gold. I'll pay the premium, I'll get a unit. That unit is nothing but derivative. In future, if it goes more than 54,000, I'll buy at 54,000. That difference amount is profit to me. Sir, what happens if it remains at 53,000 only, sir? It's lost to me. The premium which I paid for getting that unit, that security, it's lost to me. It's lost to me. Understood? So derivatives are also covered under securities. Derivatives are also covered under securities. Next one, units or any other instruments issued by collective investment scheme to the investors in such schemes. And then I'll correlate with fifth point, units or any other such instrument issued to the investors any mutual fund scheme. So collective investment scheme, mutual fund scheme. So what is there any similarity between these two schemes or any only differences, sir? Yes, there is a similarity. There is a similarity. It's a fund. Everyone will contribute to that fund. The purpose is very simple. Under mutual funds, diversification will happen. Diversification will happen. Suppose I had 1 lakh rupee. If I invest entire 1 lakh rupee in Reliance Industries Limited, suddenly there is a news from trade community that there is no more crude oil. Company had non-renewable resource, crude oil exhausted. Now tell me how Reliance Industries Limited will operate, because without crude oil they can't they can't process oils, petroleum, next one diesel, kerosene, lubricants. Understood? So depending upon macro environment, the company's share price gets fluctuated. So everyone thinks that company performance is the only reason why share price will increase and decrease. It's wrong. Because of macro environment, external factors also plays a crucial role. Now suddenly what happens? Suppose Russia-Ukraine war. Russia-Ukraine war. As a result, we are not getting crude oil. That means, no more petrol. That means turnover of the companies come down. When sale turnover comes down, definitely earning per share, net profits will come down, earning per share will come down. As a result, investors will come out of the company. So when you observe, supply of shares gets increased compared to purchase of securities. So many people will sell the securities and very few people will purchase the securities. As a result, what happens? Price comes down. Price of the security comes down. So that means risk to me only. It's risk to me only. Understood? So instead of making investment in a particular security, invest your money on multiple on many companies, diversify your investment. But how it is possible with 1 lakh rupee? How many company shares I'll purchase? If you take MRF, MRF share price is around some 70,000 to 75,000. Only one share I can purchase. Reliance Industry Limited. Okay, with this 1 lakh rupee, I may purchase some 30 shares, 30 or to 40, 30 to 40 shares. So with this 1 lakh rupee, how many company shares I purchase? So I will invest this 1 lakh rupee in Aditya Birla mutual funds. Say for example, Aditya Birla mutual funds. Now Aditya Birla mutual funds, it is issuing a document to the public. Yes, come and invest in our units. We will invest your money in many companies so that your risk will be reduced. Your risk will be reduced. Diversification. They will invest in the securities so that all securities will not fall suddenly. So risk coverage. Risk coverage. So mutual fund scheme. The main advantage of mutual funds is risk mitigation. So there would be a fund manager. Definitely there is a fund manager who will regulate all the things. Now, if Aditya Birla is inviting Aditya Birla company, inviting offers from public to subscribe their units, not shares, not at all. If company is offering shares, it comes under first point. But I'm telling you, it is inviting offers from public for subscription of units. And coming to the collective investment scheme, here the purpose is only one asset, real estate. Let us invest in real estate, or food business or pharma business. So now we are going to start pharma company. For that investments required. If Dr. Reddy Laboratories, suppose Dr. Reddy Laboratories, it is offering equity shares. It comes under first point. But what company is offering? It is offering units, and all these monies will be utilized only for one purpose. One purpose. That is the only difference between third and fifth point. So similarity, units. Based on the performance of these companies, that units values will increase or reduce. Next one, coming to the fourth point, security receipt as defined in clause ZG under section 2 of Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. So very lengthy, very interesting topic which we will read in CA final. All these points you will read in CA final, SFM and corporate and other laws, economic laws, corporate and economic laws, the derivative markets, mutual funds, collective investment schemes, all these concepts you'll learn at CA final level. This is just a brief introduction. You should not come to a wrong conclusion. Array, what is a security? Our sir didn't told, or we don't have any idea about security. Like that, wrong conclusions. You should not come at wrong conclusion. This is simply a brief introduction to the security. Exhaustive knowledge you will come at CA final level only. Next, coming to fourth one, I call it as SURFACE Act, short form, SURFACE Act. Sir, example, State Bank of India, it gave loan of 4,000 crores to Kingfisher Airlines Limited. Kingfisher Airlines, this is real story. Of course, this is a secured loan. This is not unsecured loan, secured loan. So keeping certain assets as security, immovable property as a security, SBI, it gave 4,000 crores loan to Mr. Vijay Mallya company, Kingfisher. Now what happened? Liquidity problem. Kingfisher failed to pay this 4,000 crores. Now you will get a solution like this, sir. Very happy, sir. SBI, it already had securities. No, that securities. Say for example, securities value is 7,000 crores. How much value? 7,000 crores. Now SBI can sell all those assets to realize that 4,000 crores loan plus interest. No, sir. You'll come to a solution. But I'm asking you a question. SBI business, what is the business of SBI? Selling assets, recovery of loans. Main business of SBI, giving loans, collecting interest and principal amounts. That is the main business of SBI. So if SBI starts selling all these assets, it should concentrate on selling part. It can't concentrate regular business. Now what SBI will do? It will go to a person called, suppose, bad bank company, asset reconstruction company, ARC, asset reconstruction company. So SBI will sell this loan to SBI. That 4,000 crores is an asset. So SBI will sell this asset to asset reconstruction company at suppose 3,600 crores. No, instead of losing complete money, getting some 90%, it is advantage to bank, right? So now SBI is selling 3,000, selling a single asset, Kingfisher loan, which is an asset to reconstruction company, asset reconstruction company for rupees 3,600 crores. Now this ARC should pay 3,600 crores to SBI, right? ARC should pay 3,600 crores to SBI for getting that loan, right? From where ARC will get that money, sir? If ARC is offering equity shares comes under first point. But ARC is not offering equity shares. It is offering some receipts. Some receipts. The name might be anything. Receipts. Security receipts. So it will come to the public and it will ask like this. We are having asset. Kingfisher loan asset 3,600 crores. And we had security also. Security value is 7,000 crores. Definitely within 1 or 2 months we will sell that asset, or definitely within 1 or 2 years we will sell that asset. And based on that, we will recover some 4,000 crores, and that 4,000 crores will be distributed among you. So today invest only 3,600 crores, my dear public. After 1 year, get 4,000 crores. So almost, benefit of 400 crores. 400 on, that means, 1/9 margin. Simply 1/9 of margin. So if you invest 9 rupees, you'll get 10 rupees after 1 year. So now whatever receipts offered by asset reconstruction company, those receipts also comes under the definition of security. Those receipts also comes under the definition of security. Understood? Everyone? Everyone? Next one. Any certificate or instrument issued to an investor by any issuer being a special purpose distinct entity which possesses any debt or receivable, including mortgage debt assigned to such entity, and acknowledging beneficial interest of such investor in such debt or receivable, including mortgage debt, as the case may be. I can give you a small example called factoring. So under factoring, what happens, sir? Under factoring, what happens? So today every company should offer credit. Definitely. The first point, company to do business for long period, it should provide credit sales. Credit sales means today I'll sell the stock. After 3 months, I'll get the money. But the point is, working capital requirement plays crucial role in every company, every financial decision. Working capital is an important financial decision. So what these companies will do, they will sell debtor balances, debtors to the factors. A factor is a person who initiates this factoring, So in this case, let me give you small example. So company C Limited, in the balance sheet, they had trade receivables, some 900 crores, and company will get this money after 3 months, credit period 3 months. But the point, if they get money now itself, they can use that money for next manufacturing process, for next trail, for next run. So that's why what C Limited will do, sir, it will sell all these assets to a factor. What factor will do? Factor will issue receipts. Factor will issue receipts to public. So factor will tell to public, after 3 months we are going to get 900 crores. For that, you just invest some 880 crores. Now whatever receipts issued by factor, it also comes under the definition of securities. So every company requires working capital. So now company, if you tell, so credit sales prohibited, only cash sales, sir. No, they can't expand the business. Definitely credit sales play crucial role in expanding the, in growing the turnover of the company. Every person expects credit. Today, if you ask me, sir, if you want to purchase a car, cash or finance, I will select option finance because option is available, finance. Now I'll pay this money to that NBFC or bank over a period of time. Over a period of time. Now what banker will do? Banker, there is a probability that banker will sell this asset to factor. Factor will pay the money by offering certain receipts to the public, and these receipts also comes under the definition of a security. Then only banker will get complete money. Then only banker will refinance that money. No, banker will provide that money to another person. When money gets stuck, when money gets stuck in a trade receivable or closing stock, definitely company can't run next manufacturing run, can't do next run. Are you all getting my point, students? Next one, government securities. So government bonds, saving certificates, gold bonds, everything, for controlling, for regulating inflation, or increasing money supply. These government securities will play a crucial role. Okay, which we will learn in subject economics for finance. Okay, next one, such other instruments as may be declared by central government to be securities. So in future, central government is having a power to prescribe certain instruments as a securities. So far some 8 points notified. In future there is a probability that some 2 more items will be added. And coming to the last item, rights or interest in the security. Rights or interest in the security. In capital gains, you might have solved this problem. Rights renunciation. So what is a right, sir? So every time company wants money, it will go to existing members so that dilution of control can be eliminated. Suppose if you take Reliance Industry Limited, promoters holding in the Reliance Industry Limited, suppose 6,000 crores is Reliance Industry share capital, promoter is holding some 50%, imagine 50%, 3,000 crores. This is just example. These are not real figures, illusionary figures. Now company needs some 4,000 crores. Without offering to existing members, if company offers securities to the public, imagine total paid up share capital would be 10,000 crores. In that, promoters holding, initially it is 50%, now it will come down to 30%. Dilution of control, sir. What happens, sir? Dilution of control from 50 to 30%. So even suppose I'm a member holding some 600 crores. Originally, the control I exercise in general meeting is 10%. Now without my permission, without my authority, if they offer securities directly to the public, what happened? Dilution of control. That's why every company, first it will come to the existing members. We name it as rights issue. Using a document called letter of offer, they will offer these securities. Now the point, company will give me option, sir. For every 10 shares, company is giving additional 1 share, sir. You are having 100 shares, so you will be given option to purchase 10 shares. You'll be given option to purchase 10 shares. Now I had an option, either subscribe those 10 shares or sell this option to others. So basically, the market value of share would be some 3,000 rupees. Company will definitely offer at a lesser price only. Imagine 2,700. Why, sir? Existing member, privileges should be given to the existing member, right? And moreover, if company goes for prospectus, lot of advertisement costs. Next one, underwriting commission, SEBI filings, ROC filings, everything gets eliminated. No, when company offers shares to the existing members, all this process gets eliminated. So benefit to the company, benefit to the member. Now company offered that share at 2,700. So if I subscribe at 2,700, I can sell this share at 3,000 rupees right away. I can get benefit of 300. So I'm allowing my neighbor. To get that share at 2,700 rupees. That means simply I'm selling an option. Rights. I'm selling rights to my neighbor. Now sale of rights. That rights also comes under the definition of securities. That rights also comes under the definition of securities. So with this securities definition, we completed. So the remaining part, the next part I will come in next video.